Hello everybody, welcome back to our channel. I'm Brian, President at Fundamental Research, and today I want to talk to you about risk versus return, and we're going to be answering the question, can a good company be a bad investment? Okay, so risk and return. This is a fundamental concept of investing. Whenever you invest, there's risk involved. And you should be compensated for that risk. But the amount that you should be compensated should increase the more risk you take. So let's go through an example. Government treasury bills. These are, in the US and Canada at least, probably the most risk-free investment you can make. Basically, you lend $100, let's say, to the government of Canada today, and let's say the interest rate is 1% over that year. Next year, the government will pay you back $101. The risk of them not paying you back is almost zero. That's why it's considered a risk-free investment. There are some risks that you are taking though. For example, if interest rates rise during that investment period, or inflation increases, and you are not able to buy the same amount of goods that you can today with that $100 in 1 year, even though you're getting 101. If say inflation rises 3% during that period. But let's ignore all that for now. Let's just talk about the specific risk related to who you're investing in, which in this case was the government of Canada. Okay, now let's take a different example. Let's say instead of you lending the $100 to the government of Canada, you're lending it to me. So if I promise to pay you back, if you lend me $100 today, and I promise to pay you back $101 next year, this is not a good investment for you. Okay, why? As much as I would like to pay you back, I carry more risk than the government of Canada. The government of Canada has the power of taxation, so they can raise money easily to pay you back. In my case, there would be more risk. So maybe you would say, okay, I don't accept that 101 in a year because I can do that risk-free with the government of Canada. You need to pay me 103, okay, let's just say. Okay, so now you can see why, depending on the asset you're investing in, you need to expect more return the higher the risk goes, right? So how is this relevant for you? Well, when you invest in a stock, it's the same concept, right? You should have an expectation of what that stock is worth and what you can currently buy it for. You need to determine if that expected return adequately compensates you for the risk you're about to take, right? You can do these types of calculations more formally using concepts called present and future value, and that's a topic that we will cover in a future video. So the last thing we're going to do is, now that you know this, we're going to answer the question, can a good company be a bad investment? And the answer is yes. A good company can be a bad investment, and here's why. It all depends on the price you pay, right? So, for example, let's say Walmart, the fair value of the stock is $150. I don't know what it's trading at, but let's just say that's what you think it's worth, right? It's a good company, obviously, but if you buy it for $160, then that's not a good investment, because although it's a good company, you made a bad investment. You paid $160 for something that's only worth $150. So again, it's very important that you keep these concepts in mind when you're investing. Number one, you want to be compensated for the investment, and the compensation needs to be related to the riskiness of that investment. And number two, it's very important what price you pay for an investment, because you can overpay for something, even though it's a good company, you paid too much for it, which would make it a bad investment. So I hope you learned something today. If you did, please don't forget to like this video, subscribe to our channel. Also, our analysts produce a ton of research on a weekly basis. You can subscribe and receive alerts when we have new publications on our website, www.researchfrc.com. I hope all of you are doing well, and thanks for watching.